This is John Anderson with the Agricultural Economics and Agribusiness Department at the University of Arkansas. Happy to join you at least virtually for your Officers and Leaders Conference, and I hope it goes well as you sit in your respective homes or wherever you are watching this. I was asked to provide a kind of a quick market update, a little overview of COVID-19 impacts on agricultural markets. And so I want to try to cover that in 15 minutes or so, and won't be able to give you a lot of detail, but want to at least talk about some of the big picture issues that are going on in our agricultural markets and in markets more generally as a result of the ongoing COVID-19 event that we're all dealing with. So let me get my slides going here if I could, and kind of go through some of what's going on, and kind of want to start with a little overview. We're far enough into this event that I think a little bit of perspective, backward-looking perspective is useful here, and I'm stealing this slide from Jason Lusk at Purdue University. Remember in early March, this is when COVID impacts really started in a big way in the United States. That's when we saw people stocking up on food in grocery stores. A lot of the shortages and supply chain disruptions related to the surge in buying behavior for food and other staple products really started then. By mid to late March, we were into a little more complex shock from the COVID event. At that time, we saw a lot of restaurants start to close, and we had really a virtual overnight elimination of food away from home, and an ongoing spike in grocery demand as that demand had to transition from food away from home to the grocery chain. And we still had some, I think, some stockpiling going on at that time. In early to mid-April, we started to see a little return to normalcy in the grocery supply chain. Things had been re-optimized for the loss of food service and to shift more product through grocery outlets. And a little bit of sense of normalcy starting to return there. But then by late April and mid-May, we got into what I think were the most significant shocks of this event, and that was the loss of beef and pork and poultry processing capacity because of COVID-19 in plants, because of other supply chain disruptions, worker safety concerns, the need for social distancing in plants. All those things kind of came together to effectively reduce capacity in the processing sector and really highlight the effect of where that bottleneck in the supply chain was that caused real disruptions on both sides, both down to the farm level and up to the retail level. From June to now, we've seen more or less a recovery in meat packing. Still, I think a little bit tenuous in terms of calling that a full recovery, and I think we're going to see the effects of the disruption playing out in down to the farm level for some time. But we have recovered most of the volume in processing capacity at this point, and we are seeing a return of food away from home consumption as restaurants open up. Although again, that's fairly tentative, and a lot of social distancing there is reducing the capacity of that sector. And we are seeing kind of an uneven reopening of state economies. And again, I think we may see some up and down in that as some states tighten lockdowns back to greater or lesser degrees. But from here on, I think we will see sort of this uneven rolling reopening and staying open of economies, which makes it a little hard to assess what disruptions might look like moving forward. In terms of what this has meant to the economy, fairly large drop in gross domestic product, about a 5% drop in first quarter GDP. And keep in mind that this event really didn't start to affect the economy in a big way until really close to the end of the first quarter. So a 5% drop in the first quarter, given that we really had the effects concentrated in the last 2 weeks of that quarter, is really significant and suggests that the second quarter effects will be massive. No question this has induced a recession in the economy, a formal recession, which we always used to describe as 2 consecutive quarters of negative GDP growth. We're certainly going to have that in a significant way. The numbers on employment are kind of striking as well. If you look at monthly change in employment, total non-farm payroll employment in the last couple of months has looked really good. In May and June, we gained about 7.5 million jobs in non-farm payrolls. And in a historic sense, that looks tremendous. Changes in employment of couple of 300,000 people month to month are kind of a big deal. And so when you start talking about millions of jobs added in a couple of month period, it's pretty striking. Unfortunately, that follows a period when we had lost 22.2 million jobs in the March-April 2-month period. So yeah, historic gains in the last couple of months. Still pretty far from making up the historic losses that we saw in March and April. The unemployment rate in June was 11.1%. That was actually a couple of percent better than most analysts expected, and a very positive sign, I think, for prospects moving forward, but still a very high unemployment rate. And put that in perspective, in the post-war period and all the recessions we've had since World War II, I don't think we've ever had an unemployment rate higher than 11%. I think 10.8 in the early 80s, which was a pretty severe recession in terms of employment effects, is the closest analog we have. And so the unemployment impacts of COVID have been fairly dramatic. Obviously, the stock market's been affected in a big way. That's a fairly useful sort of broad barometer that a lot of people use to assess the economy. And we were bouncing around about a 30,000 level on the Dow Jones Industrial Average before COVID. Major drop down to about 18,000, just a little better than 18,000 when we were in kind of the depths of the COVID impacts, and a big recovery since then. We're bouncing around 25,000 on the Dow, which is, all things considered, I think very good. A lot of analysts are questioning what's behind that, given the historically high unemployment figures. Given the major spending changes that we've seen, there's a lot of liquidity in the market because of what the Fed has done. And I think it's a little hard to assess exactly what that Dow recovery means, but it certainly has been a notable bounce back from the depths of the COVID event. Consumer spending, let's start to move a little closer to home to the ag sector. Consumer spending on food month over month has been a pretty wild ride. And I've got 3 years of spending here. We could go back 20 years and it would look about like those 2018, 2019 bars. But when we get to 2020 and we look at March and April and May, which is what we've got data on at this point, the gyrations in food spending have just been phenomenal. We saw in March massive increases in spending on food at home. The grocery store spending, a massive decrease in food service spending. In April, we saw both of those drop. At the grocery level, basically, we saw kind of the snapback from all the stockpiling that had gone on in March, and we saw the effect of people really being confined to their homes, and all spending was down dramatically. In May, we got a big percentage increase, a percentage recovery in food services and accommodation, that food away from home spending. Still a long way from where we were pre-COVID, but a pretty good bounce back as economies started to open up. And food and beverages for off-premises consumption also bounced back some as lockdowns eased and people started getting back to a more or less normal in terms of grocery spending. Another look here, and again, this is Jason Lusk and Tim Richards. Tim is at Arizona State University, provided these graphs on foot traffic in supermarkets and in sit-down restaurants. And you can see the big surge in 2020 in foot traffic in supermarkets as the stockpile buying was going on. Huge decline and a persistent decline in foot traffic at sit-down restaurants as those facilities were just absolutely on lockdown. So fairly dramatic macroeconomic data on the impacts of COVID. Clearly a massive event in terms of its impact on markets generally. That has translated into big impacts on our agricultural markets as well. I want to pick through our major commodities here and talk about some of the effects specifically with livestock and poultry. I think arguably to this point the most affected markets we've seen by COVID. We had the initial effects on demand, the big surge in food at home buying because of stockpiling, the dramatic loss of food away from home. When we had supply chains that were optimized for one of those tracks or the other, that created real disruptions that affected the meat sector pretty significantly. Obviously, the later effects, I think, were the bigger ones when we saw processing plants close down, and the effect of losing the market represented by a large processing plant was dramatic on farm level prices. Losing the wholesale supply that a major processing plant represents was a dramatic effect on the retail sector. And so on both sides of the market, we saw massive effects, huge price spreads between farm and wholesale prices, and even some product availability issues around the country. Got some graphs here that kind of illustrate these effects. This is weekly federally inspected cattle, hog, and broiler slaughter as a percent of the previous year. So each week, the year-over-year change in cattle, hog, and broiler slaughter, and you can see there that April drop in processing capacity, really primarily for cattle and hogs. We did have some poultry disruptions, but those were less widespread, and that is a more diffuse industry in terms of processing capacity than cattle and hog industries. But down 35% year over year in terms of both cattle and hog processing at the same time is really an unprecedented event in the sector. The price effects, I think, also were unprecedented in terms of what happened with farm level prices. And the example I have here is the 5-area weighted average fed steer price. Huge declines compared to a year ago, compared to the previous 3-year average, as we lost the ability to move those cattle efficiently through the supply chain. Same thing happened to a lesser extent, but pretty dramatic changes also in barrel and gilt prices for exactly the same reasons. In terms of wholesale meat prices, kind of the opposite effect as those wholesale suppliers were disrupted. Wholesale prices shot up. The box beef cutout value reached a historically high level. The pork cutout value increased quite a bit, not to levels we hadn't seen before, but obviously a massive spike in pork cutout from where we were pre-COVID. The broiler composite kind of went the other way. Again, I think more affected by the loss of food service. Big drop in price there with a recovery close to the pre-COVID level once the processing disruptions were under control. But again, still looking at year over year below where we were pretty significantly in wholesale broiler prices. And again, a big effect of food service on that. Probably the bigger disruption in the broiler industry was with placements, as all the integrators really kind of scrambled to figure out how much capacity they were going to have and how much demand was going to be in place and how they were going to adjust to the food service loss. They really slammed the brakes on egg sets and chick placements, although as of now, we are back about to where we were a year ago in terms of chick placements. So a little bit of a hole in that production, but fairly significant recovery, which suggests for the latter half of the year, production levels will be pretty close to what they were pre-COVID. Although, again, I think there's still a lot of risk in the market and a lot of potential for regression in terms of our management of the supply chain. In the cattle industry, I would say the disruption of processing capacity is really going to be felt for the rest of this year and be have a negative impact on the market for the rest of the year. And the reason I say that is because of that slowdown in processing when those plants were closed, we really backed up our inventory of fed cattle quite a bit. And we do. It looks like still have something of a glut in the supply chain that'll take at least a few months to work through. Two numbers here that really support that: the weekly average steer dressed weight running much higher than it was a year ago. Really, we kind of obliterated the normal seasonal pattern in steer weights because of the way those animals were backed up in the feedlot when processing was delayed. And if you look at the number of cattle, it's the calculated number, the inventory of cattle on feed more than 120 days. It has really spiked again as cattle have had to be delayed in that supply chain. And those big front end supplies tend to be a really negative factor for the cattle market when events like this occur. And this is probably the most dramatic, rapid buildup of front end supplies that we've seen maybe ever in the cattle market. Switch gears and talk about forestry and wood products a little bit. This a market we don't always talk about when we talk about our ag markets, but obviously very important to the state, very important to a lot of our landowners. Really crazy situation in that market with the huge surge in demand in pulpwood and paper products as all the stockpile buying was going on. You know, a lot of us, I think, saw empty toilet paper shelves for the first time in our lives, and hopefully the last. On the saw timber side, things kind of went the other way. A very negative effect as a general slowdown in the economy tends to be highly negative for the saw timber market. That's exactly the case this go around as well. So overall, the short-term surge in buying kept pulp and paper mills busy, but everything else slowed down fairly significantly. And moving forward, I think the general economic slowdown that we're seeing in response to COVID is going to be a long-term negative for that sector all around. Row crop impacts are kind of mixed, much less dramatic than in the livestock and poultry sector for the most part. There has been, I would say, a major negative shock that coincides with has coincided with an increase in supply that we saw as producers had ramped up, not just in the U.S. but globally, in response to expected strong demand from China. So this negative demand shock really came at a very inopportune time because it came right on top of building supplies. Reduced demand, I think, has affected and is going to affect all food and feed grains, oil seeds, fiber products, really across the board. We've seen big effects on the corn market and the cotton market in particular because of the low energy prices that this demand shock created. Low energy prices means less demand for ethanol, really an unprecedented slowdown in ethanol demand. It means very inexpensive synthetic fibers, which is a negative factor for cotton demand. So those two crops already affected fairly significantly. Rice prices haven't really been affected too much yet. Some of the global suppliers around the world put on export restrictions, and those tend to boost the world price to some extent. But overall, I think if you look longer term and kind of get away from the short run effects and look longer term, the general economic slowdown around the world that we're seeing related to the COVID pandemic is going to be a long-term negative for the row crop sector. And my big concern for this sector is that prices could remain under some pressure really into the next marketing year, into the 2021 marketing year, if economic recovery doesn't proceed fairly quickly. Again, all this is subject to change. We're at the time of year when we might have weather-related production shortfalls or other disruptions that would have the effect of counteracting the effect of the economic slowdown. But as we say as economists, ceteris paribus, all else equal, the economic slowdown is going to be, I think, a longer-term drag on these row crop markets. Couple of charts here to illustrate kind of what I've been talking about. Cotton futures really fell sharply as we got into the early part of the year. And again, I think COVID was being felt globally earlier than it was being felt in the United States. And I think that's reflected in the timing of this downturn in the cotton market. If you look at corn futures on the left here and soybean futures on the right, both of those began to drop fairly dramatically when we got to about mid-February, which coincided with the beginning of the U.S. COVID concerns in a big way. Some recovery lately as we got some positive news in the planting report, but we have taken quite a bit of value out of a lot of these crop markets. In terms of specialty crops, COVID has been fairly disruptive. Big surge in demand from panic buying affected specialty crops as well as a lot of other ag products. The loss of food service had a massive negative effect on a lot of specialty crops. One thing that I think was different in the specialty crop market, particularly if you look at the situation within the state or locally, the loss of institutional business had a huge impact on a lot of individual growers. We have a lot of growers that are set up to do farm to school type programs or to supply local food service outlets, and those supply chains disappeared overnight and created a big problem for a lot of both commercial and small scale producers. Looking ahead, I think there are a lot of concerns in this sector, as similar to the meat processing sector, about labor availability and worker health and safety, and how long-term that might affect markets in this sector. A quick word about ag finance and the financial position in agriculture. FAPRI right now is estimating a $20 billion loss in farm income. You know, if you compare that to what's in the CFAP program, that leaves about a $4 billion gap, which is not huge. Obviously, there are concerns about how well the CFAP compensation matches up to losses, both across sectors and really over time, as we potentially see losses mount due to the general economic slowdown. I suspect that $4 billion shortfall may end up being a little bigger than that as some of these delayed effects work their way into the market, but that does remain to be seen. Farm profitability clearly will be stressed in 2020 due to COVID effects, barring some other unforeseen development that boosts prices on some of these major commodities from where they are now. Overall, if you look at the ag finance sector generally, the sector's not in bad shape in terms of liquidity. Obviously, we've had several years of low income, and additional losses will compound a lot of individual stress. Ag lenders, in terms of their availability of funds and their willingness to lend funds, seem to be in a position to keep liquidity flowing, which certainly should mitigate the worst case scenario kind of outcomes, but still fairly significant losses should be expected for the sector in 2020. And again, if we see subsequent waves of COVID, subsequent lockdowns, things could get worse than they look now. And again, to summarize the financial position there, significant losses, but with enough resilience in the sector at this point to absorb those, although certainly not without pain. So in summary, major effects of COVID-19 have really occurred across the entire economy and certainly within every aspect of agriculture. We saw major problems related to supply chain bottlenecks. I think it was eye-opening for a lot of us to see really how disruptive those downstream effects could be within our sectors. And that has created massive short-run losses in some sectors. Those losses are going to affect the market for some time, particularly when you look at cattle for the reasons I just talked about. That sector has done a good job actually getting back up to speed, all things considered. But again, I think recovery is still a little bit tenuous because there is the potential for subsequent COVID events and COVID occurrences to continue to disrupt that sector. And we have seen the vulnerability that creates for us. Row crop effects have been mixed, but generally negative so far. I think the major risk for this sector is really what we might see down the road in the next marketing year if an economic slowdown precipitated by COVID really persists as we move into next year, which is certainly a real possibility. With that, I'll stop. I appreciate the opportunity to talk to you and share with you. As always, my door is open and my phone is on, and I am here to help in any way that I can. Hope you have a good conference, and appreciate having the chance to talk to you.